Rana Gupta, Senior Portfolio Manager, India Equity Specialist at Manulife Investment Management. Rana, good to have you with us here. Thank you very much. You know, the Fed Chair Powell said rate cuts are coming into view. And since then, we've had official after official, three of them saying, well, cool it, not so fast. What's going on? I mean, did they underestimate the ferocity of the market reaction? What should we go with what they're saying now or what the Fed Chair said then?
Good morning. Thanks for having me. I think the market's pricing in, as you're aware, that about 6 rate cuts in calendar year 2024, whereas Fed dot plot shows, I think, 3. So I think there is again a gap between what Fed is seeing the rate cut trajectory versus the markets. So I would think that the Fed governors in the subsequent week, they're just trying to bridge the gap. But I want to make a more important point here, that whether the cut is 75 bips, 100 bips, or 150 bips, that only time will tell. But the most important statement coming out of the last meeting was that the risks are now balanced, which means if the economy were to slow meaningfully, Fed will be there to cut rates. The risk for emerging markets were always going to over-tightening and a hard landing in US. But with this balanced word coming back in the Fed speak, and the Fed being ready to cut rates, I think substantially increases a soft landing scenario, which is a positive for emerging markets, including India.
Okay, Rana, hi, good morning. Always great speaking to you. And this is, the end of what has been a fabulous year for equity markets, right? The Nifty by the end of the year is up almost 20%, and the mid-cap index is up almost 45%. We haven't seen a year this good in a while. Do you think India can replicate these kind of returns in 2024?
So I think even if you look at this year numbers, right, like you rightly said that markets are 20%, but mid-cap 45%. If you go to the sectoral indexes, real estate, I think you were just mentioning 60%, capital goods 60%. So I think the broader point is that market remains reasonable. I think 20% reasonable return, one should really settle for that. It can be a 15 or 12% also going into the next years. But the real action will continue to lie in different sectors and different stocks. Just like, if I take a step back, previously people used to think about emerging market as one entity and they used to allocate capital. I think that's slowly changing. They're looking at India and other markets individually. Within India, I think we have to also look at sectors differently. We cannot, we can take a call on the market, 10, 12, 15% upside or something like that. But I think more importantly, we need to take a call on sectors and the stocks. For that matter, I think we have been and continue even more bullish on the domestic related sectors than the international exposed ones.
Okay, all right. Hi, Rana. Well, 2023 clearly has belonged to India in comparison to China. But India is trading, at elevated multiples and maybe with good reason. But current reckoning, do you think that, there could be some kind of a play that moves to China maybe in the next 6 to around 8 months? The longer term, yes, India is looking much better. But at these multiples with the kind of very, very weak economic data coming out of China, something's got to give. Your take?
So I think, first of all, I think going to next year, we have a constructive view on the FI flows because it's likely that US will cut rates, but I don't think the strength in emerging markets, necessarily the central bankers in emerging markets will follow to the full extent, which means a lot of flow could come here. So even with the flow coming here, China could get some share, but I don't think China is going to get the share that it used to get, which means emerging market takes China, the flow, the pie, the FI flow pie is going to get somewhat bigger than in the past. Coming to China specifically, I think the economy is slowing and their government of late, the authorities of late are doing quite a bit in terms of fiscal, even they have loosened the fiscal string also a bit. But the problem with the longer term problem with, I think, China now is about their demography and the declining, the age profile. So the point is the real estate and the exports, which had really driven the economy over a long period of time, both are in some sort of challenging situation right now. Export we have discussed why, and real estate because of oversupply. Until these two problems are specifically resolved, I think all this kind of stimulus will only give the market or the economy some temporary recovery. And to that extent, I think emerging market ex-China, particularly the market which has large hinterland like India, will continue to be one of the favorites for the investors.
All right, we'll let you go on that note. Thanks a lot for joining in and giving us your quick take. Happy New Year to you and your entire team, Rana. Hope to see you again very soon.